We have some duration in the portfolios, right? Relative to where we could be or relative to our history, we're certainly probably more in the middle of the road. And the reason for that is we want to wait this risk events that we have, particularly the ones today, to sort of pan out. And also we want to get a little bit more clarity on the cycle, which is not clear to us, right? That means that we're not maxed out on duration. But of course, we stand by this view that in asymmetry terms, you can make more than lose in treasuries here. Now, there is, of course, a risk that you can sell off another 100 bips from here. I mean, we are running pretty high nominal growth in the U.S. That is a scenario we have to consider. And there is a possibility that the Fed can re-engage with rate hikes. And so that does put bonds under pressure. Now, I would agree with Druckenmiller in terms of the front end of the curve. That has been interesting for us, and that's where we've been shifting more of our exposures in terms of
But would you be willing to do what he's doing, a massive bullish position? I don't know what massive means, but would you be willing to go massively into that?
When he says massive, he really means massive. I don't know. I can match his firepower. But, also, he's running his own money, so it's a little bit different. But I mean, jokes aside, yes. I mean, I would say on a scale of 1 to 10, I would say we're probably more close to like a 6 out of 10 right now. So I think it still pays to be a bit cautious on rates. I think vol is pretty high, and I do worry about this element that I was talking about. What if we are wrong and 5% is not the trigger for the Fed, and we actually can go higher to 6%? You have to allow for that probability. I don't think it's our core case, but it's a risk, and so we're managing the risk in the portfolios with that in mind.
Yeah, I mean, folks who started out confident this year that it was the year of the bonds, were proven very differently. So fair enough on the cautious point.